You could be wiser as an educated advisor. Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, the Tax Sanctuaries, part one of our series on cash value life insurance and tax-free income, all here on Let's Get Down to Business. Well, welcome everyone. We're in our seminar mode here at Let's Get Down to Business, and I'm using a slide deck that I use from my business-to-business events called Tax-Free Retirement Income, and if you like the slide deck and the presentation, I'm happy to do it. I want to talk a little bit about why we're talking about tax sanctuaries here today, because it's really important to me to really lay out the thinking behind it. Now, a couple years back, I went to the Thunderbird School of Management, and it was really amazing because they had several different seminars. I think there was like 13, 14 different seminars, and people from all over the world flew into Scottsdale. Some of them were multimillionaires and a few billionaires, and they're looking for different things that are happening in the market that are eclectic, tax advantaged, just different investment postures and possibilities. They're just in there to really look and scope out what's new and hot. It's kind of like going to the NAMM show if you're an electronics person. But think about this. I went there because I wanted to see what kind of presentation they were doing on the #1 seminar in that time, at that time, which was VUL offshore. I wanted to look at it, and one of the reasons why was because it was a tactical play for taxes. It was a tax sanctuary. It was a tax-free way of playing in VUL offshore, and I was really enticed by the whole idea. And when I went one step further than that, I looked at our normal tax-free with life insurance because it's so popular. Now, one of the reasons why cash value life insurance is a huge tax income play, tax-free income play, is because there's two demographics here. And it's really huge because right now, as you know, the basic idea of trying to pay the least amount of taxes under the code legally is the game for the affluent as well as the middle class. The affluent are seeking tax relief from ordinary income taxes and capital gains. And keep in mind, with Obamacare, the actual capital gains was not 15 or 20. Capital gains became 23.8%. So that's a big chunk of somebody's money in capital gains, even at that level. So we're looking at it from 2 points. One is affluent taxpayers, and also we're looking at it from the middle class. The middle class is not only looking for ordinary income tax relief, but they're also looking for Social Security, especially if you're a senior, Social Security benefit taxation relief. Keep in mind that many people are paying taxes on Tier 1 and Tier 2 Social Security. So it's really artful if you're a planner to be able to address taxation. And to me, this is one of the big reasons why cash value life insurance can be so important in a portfolio, especially at the time that we go to retirement. Now, why life insurance? And this is just a curiosity that people always ask me, Steve, why is life insurance so important? Well, under the code today, we still have some advantages that are really great. And one of those advantages is that we can take withdrawals of basis, our original contributions, and we can take collateralized policy loans of gain. And as long as we keep the contract in force for the life of the policy insured, not the policy owner, not the policy beneficiary, but the policy insured, and we keep it in force during their lifetime, those withdrawals to basis and policy loans to gain are tax-free. And remember that policy loans or equity position from your home, things like that, aren't really reportable income. So it's really an advantage for cash value life insurance to be able to take out collateralized policy loans and basis, which is actually withdrawn, and it's very easy to do and understand. Once you understand, those are the two components. But the big key is keeping the policy in force for the life of the policy insured. Now, the first thing when we talk about tax-free sanctuaries is I talk about life insurance, because most people use it for coverage, and there's nothing wrong with that. Indemnification is a great need, and I like protection thinking when I'm talking about defensive planning. But at the same time, I look at life insurance because of its tax advantage income possibilities. And so when I'm looking at tax-free, I always bring this out. And remember, later on in the series, we're going to talk about the 4 different life insurance chassis: par whole life, universal life, index universal life, and variable universal life. We talk about all 4 of them. We're really agnostic. We need to do a risk tolerance test on the client to find out which one we're going to go to and which one is suitable for them. So you have to do a risk tolerance test, and you have to do a suitability test on what you're going to use, whether it's par whole life, universal life, index universal life, or variable universal life. Then the second thing I want to talk about is Roth IRAs. Keep in mind, I'm kind of the ilk that if you're going to be putting money away for retirement, if you're in a low tax bracket and you're not getting a match from your employer, you might as well look at Roth IRAs. If I am not in a high tax bracket or I don't have a contribution match from my employer, I might as well use Roth IRAs because I like the ability. I don't get the tax deduction, it's true. And including life insurance, it's not taxable. But both of these accumulate tax deferred, and both of them come out tax-free. Again, life insurance is from a collateralized loan and withdrawals to basis, and Roth IRAs come out totally tax-free. So combining both of those together from a tax-free point of view, if you wanted to really start moving towards tax-free retirement thinking, those two are really two components that I got to have in my quiver if I'm going to use and try to construct and design a tax-free, an ultimate tax-free under current law. Now, remember, reverse mortgage is under the HECM law. It's under HUD, insured by the FHA, and you're using a reverse mortgage. You're taking the equity position out of your home and you're taking it as income. Because it's a loan technically from your home, that money is really tax-free. So you're taking an equity position, and many middle-class boomers, after going through the 2008 debacle and the market meltdown, are really looking to reverse mortgages right now in the equity positions of their home, because this is now helping them supplement their Social Security and their battered qualified plans. And I say battered because at about 215 is when we actually most people got back to par, and we're above the line, and it's been pretty good market lately. But ultimately, people are using reverse mortgages because they need the extra income to supplement their qualified plan as well as their Social Security income. And then the last, health savings accounts. I can't underscore, especially if I was a young person and a millennial again, I would be trying to fill this as much as I can. What I like about making maximum contributions is if you're a married couple, it's 65, 50, under 55, age 55. I like health savings accounts because you're going to use it. It can be used for Obamacare premium or health premium tax, long-term care, disability insurance, all those premiums, and any legitimate expense caused by medical, hospitalization or going to the doctor. All those expenses can be used in your HSA account. So you're getting a tax deduction with your HSA, and it doesn't cost you any money. You're not being taxed when it's withdrawn. I don't have to wait till 59 and a half or age 62 or 65. I can use this all my life. And believe you me, when you're young and you say, boy, I'm putting this in a health savings account, you will use it throughout your life, and especially when you become a senior. So this is really good money. The best tax issue that we have out on the street right now. Tax deductibility, it accumulates tax deferred, and you can put it in CDs or whatever investment. I would say keep it conservative and liquid. And you can also pull the money out for any insurance premiums that are medical, long-term care, disability, things like that, and even Medicare premiums. But you also want to use it for your medical expenses and costs. So all four of those. And then one little side note about HSA accounts or health savings accounts. The IRS allows a once-in-a-lifetime exchange of up to $6,550 if you're under 55, a one-time exchange where you can go to your IRA. You can't do it with a 401k, it has to be an IRA. And you can move money from a qualified taxable IRA and move it and exchange it to the HSA tax-free, and as long as the money's coming out for insurance premiums or qualified medical expenses, that money's coming out tax-free. You get one time in the opportunity in your life to do it. You cannot make that one time while you're actually funding it. So in any year that you're short on money, I'm just going to go to my IRA and move it over there. If you're over 55, we get a $1,000 catch-up provision. So now I can put $7,550 from my IRA into my HSA, no taxable event on the transfer, and no taxes coming out. Again, as long as it's used for legitimate premiums, insurance premiums, and expense loads. Keep in mind that all four of the income that comes from these do not find their way over to the provisional income test. So Social Security, you're not going to get taxed on any of these four because of Social Security. And if you use your deductions and your exemptions artfully, you may actually be able to cobble together a total tax-free income for your retirement using these four and your deductions and exemptions to offset your Social Security income. Pretty powerful. And don't forget to watch our next segment on tax consequences for seniors, part 2 of our series on cash value life insurance and tax-free income. And keep in mind, before moving forward with any of the ideas on the show, always check with your tax consultant, legal counsel, or compliance officer. And don't forget to subscribe to my consumer show, Steve Savant's Money, the Name of the Game. Daily content that you can post on your website, social media accounts, and database distribution. I'm Steve Savant. Thanks for watching.